Howdy, Jacob here. Today we're looking at the company Alcon, company 22 in our generic screener, just under 40 billion market cap on just over 43 billion enterprise value in the healthcare and equipment supplies industry. It looks like they research, develop, manufacture, and distribute eye care products, and their growth has been fairly consistent outside of COVID. You're really looking at mid-single digits here with gross margin increase to mid 50% operating margin, going from really negative to almost 11%, double digit now. And return on invested capital isn't anything to brag home about. They are paying a dividend now, which is weird. They just started making money, so it's a little odd. But balance sheet has a little over $1 billion cash on hand and about $4.5 billion long-term debt. That $4.5 billion long-term debt is a good amount of their free cash flow. On a 5-year average basis, you may be looking at about $600 million. And so $4.5 billion is definitely a hefty amount of that $600 million. You're looking at about 7.5, 8 years there. So that's a little bit concerning initially. Again, this is just, everything I say is just part in creating the whole of the story that we're looking for. So to have 8 times debt, again, think about yourself. If you were just starting your career, you might only be worth $100,000, $150,000. But if you were making $100,000 a year, you could definitely afford a $500K house. So even though, you're making $100K, you net out your tax and everything, you're probably making 70 or something. Well, this is after all your taxes, your trips, your whatever. 5 times that, it is pretty reasonable. But here, when it's due in a period of time that's usually 2, 3, 4, 5 years out, does make it a little bit more concerning, because that means they're going to have to change. They're going to have to change the way they allocate their cash flow to reinvestment, share repurchases, dividend, into just paying down debt, or they're going to have to, risk the possibility of just refinancing the debt. And there's always a chance that their debt issuer won't refinance it. Obviously, there's a lot of people that issue debt, so I'm sure they'd be able to find something as long as their, their debt ratio isn't too extreme. But it does get a little bit concerning when you're over 5. It just to me tells me that they don't really care about it, and that's more of a concern that I have. Like, if you have, if it was $6 billion over here and then they've paid down $1.5 billion already, then as a shareholder that they have the capability of buying it down. Not only the capability, but they also focus on it. And here they haven't focused at all about paying down that debt, really, just really increasing it. So that's more so the concern of mine. It's just the behavioral aspect. And again, just one part to create the story. The use of cash is mostly acquisition and reinvestment, with the dividend paying out about 15% of their 5-year average. So pretty small dividend, and on a yield basis, 0.3%. So it definitely is a pretty small dividend. But I think I'm ready to make some assumptions here. I think I'm pretty comfortable with a 5% growth rate. And then at the end of 7 years, put 16 PE, pretty much market average. I think the growth and the moat status is, very, very average. So I'm going to give it the market average. And then for margins, I do like that free cash flow is quite a bit higher. So maybe it'll merge closer to that free cash flow figure. And then share repurchases on 40 billion, you're looking at about 400 million. To decrease 1%, yeah. Maybe I'll just keep it. I'll just do that. So that's basically 144 million. They haven't really repurchased any shares, so really they're just going to get diluted due to stock-based compensation, and that's roughly 30% increase, or 0.3% increase in shares. Based on their current market cap. So again, that can change based on what their market cap is, if their aggregate stock-based compensation doesn't change everything. But for now, pretty comfortable with that Because again, these are just assumptions to create the story. And the dividend is pretty light, so have they increased that? I guess it's pretty new. Let's increase that maybe a little bit more than their revenue growth due to the fact that it is like 15% right now of their free cash flow. And yeah, it just looks extremely overpriced to me. So really no surprise there. You're looking at a 40p. I'm dampening it to a 16, and revenue growth is nowhere near the discount rate. So you're definitely dampening, getting that margin P depreciation as well as the growth not up substantiating the discount rate. To me, interesting company, but it's really nowhere close. So I'm not going to waste my time doing a further review. Thank you.